So normally at the beginning of every month, I drop a video about monthly dividend stocks that you should definitely invest in this month or that particular month. But I've learned that depending on the stock or the ETF that you're investing in, getting a quarterly, semi-annual, or annual dividend check isn't necessarily that bad. It's also all about growth investing as well. So in this video, we're gonna talk about 5 different dividend paying stocks that have the potential or have had the potential for growth. So let's begin. What's going on, guys? My name is Darren Jackson. I hope you all are having a great day so far and have had a great week so far. I'm excited because it's August. I can make a new video about stocks to invest in. And my birthday is actually tomorrow, which is August 8th. I'm recording this video a little bit earlier, so you guys won't see this at least until 5 days after my birthday. So honestly, guys, a great birthday gift would be maybe a like and comment. And honestly, I don't ask this a lot, but consider sharing the video to other people if you find this content to be great, or even subscribe to it. But obviously I know I have to earn your subscription, so let's get started with the content. So as I've said before, monthly dividend paying stocks are some of my favorite stocks, and I love talking about those every single month, and I more than so will. But I've also learned that you can get all the monthly dividend checks that you want, but if it's not outweighing your overall growth, then are you really undergoing true passive income? So what I mean by that is you can get $100 a month off monthly dividend checks for the rest of your life, but if your investment portfolio is suffering $110 loss every single month, then you're basically losing $10. All those stocks and all those dividend checks really don't do anything for you. So it's not necessarily the worst thing to invest in stocks that have a lot of growth and maybe give you a smaller percentage of dividends, and they give it to you at a slower rate. That's not that bad because you're growing at the end of the day, and you can use those funds to reinvest and do whatever you want. And when you have a bunch of these stocks, you're essentially getting them every week and every month. So for this video breakdown, we're gonna go over 5 different dividend paying stocks that I personally believe that you should invest in this month, and I've already either invested in or will definitely invest in very soon. Now, one of these stocks we're gonna title the honorable mention, and you'll understand that once we get to it. 2 are the stocks that have already shown growth and can continue to show more growth. The 4th stock is actually a high dividend paying stock, but shows a lot of potential for growth because it kind of already has. And the last stock, just to be nice to you guys, is a monthly dividend paying stock, but it does show a lot of growth and a lot of consistency in payouts. That should be a hint of what it is, but just stay tuned and we'll get to it. So the first dividend paying stock is our honorable mention. It is Disney. And the reason I call it the honorable mention is because it does show a lot of consistency of growth. And I do feel like at the end all be all, it's gonna be one of the last standing juggernaut corporations in this entire world. But there's a lot of good news and a lot of bad news when it comes to investing in this stock. Now, personally, I love giving out the bad news first. I wanna rip the Band-Aid off quickly so you can start feeling better quicker. So for the bad news, in Q2, they've shown about $5 billion in profit losses, which in comparison to 2019 Q2 is pretty bad because I believe then it showed about a $2 billion gain. And that's primarily responsible for 2 of their 4 major aspects in their Disney economy. One being their theme parks. Not a lot of people are going because of this current pandemic that's going on. And the cruises. Not a lot of cruises are being actively done for the same reason. So they're losing a lot of money every single week and every single month that they were originally getting a lot of money from, especially when it comes to summertime. That's all people want to do, theme parks and cruises. The third aspect of it is their movies. They're losing a lot of money from the lack of movies that they're premiering because production companies and cast and crew don't want to get together because they're afraid of the consequences of this pandemic, which is completely fair, unless you can kind of contain them in a specific bubble. Keep that word bubble in mind because I'm gonna bring that up again in a second. But a lot of movies aren't being made, and that's really important, especially for Disney, because if you look up the top 10 at least grossed films of all time, I'm pretty sure at least half of them are Marvel films, which are Disney-made movies. As a matter of fact, Avengers Endgame came out May of last year, and I believe that's #1 of all time. So them not making movies is definitely a bad thing. Now, the good news with this stock is that even though they haven't been releasing movies, a lot of people have been recommending, why don't you release movies on Disney Plus? Disney Plus is their online platform, which a lot of people are subscribing to every single day, and that number has been increasing. And they just announced that they're going to be releasing the live action movie Mulan, which I forgot when it was originally supposed to come out, but they announced that it's going to come out by September 4th on Disney Plus for $30, which sounds like a lot, but keep in mind, at an average movie theater, that's about $10 a ticket. So you're looking at least 3 people you're bringing to your house to watch this movie, and it pays itself off right then and there, and you have your own food to make. So I'm not quite against that. The bubble aspect of it has to do with sports. Sports are slowly starting to come back, and that's important for Disney because Disney owns companies like Hulu and ESPN. Now you have baseball, which isn't doing so great, but you have a sport like basketball, which is doing amazing. They consistently show days of no positive tests for any of their players, and they're continually able to participate in these sporting events. And I have a feeling that when the NBA Finals starts, that we're gonna get a lot of people watching at this point in time, which I'm really excited about personally. So I feel like eventually sports is gonna start to elevate a little bit, which is gonna help Disney out a little bit as well. So now the next 2 stocks we're gonna be talking about are stocks that have grown tremendously, and I feel like will have the potential to continue to grow. Now, the second stock we're talking about is another ecosystem, and it's probably the most popular stock that people are talking about now, and that's Apple. Now, Apple has one of the, if not the greatest ecosystem of products, and that's really hard for me to say because I'm a lifelong Samsung user, but you know, you gotta recognize real game. So they are crazy, from their iPhones, which are continuously being made every year, and people are always upgrading to the new iPhone because they can't do what the old iPhone does. Their MacBooks are selling out hard, their iPads are selling out hard, their iOS system is safe and secure. It's just ridiculous. Apple TV came out pretty recently, and there's a lot of big movies and TV shows starred by a lot of major actors and actresses, and a lot of people are subscribing to that as well. And probably the biggest news that Apple has released in the past couple of days is their 4-to-1 stock split. So this 4-to-1 stock split, I believe, is going on for 2 different reasons, more so one than the other. One of the reasons is that Apple's part of the Dow Jones Index, and there are ETFs that track the Dow Jones Index, including, I believe, DJIA, which is a stock-weighted ETF, meaning that whenever you invest a share into that ETF, that sector is going to be made up majority of the most expensive stock. I believe Apple is the most expensive stock. So every time you invest in that ETF, you're actually getting about 10% back of Apple, which can be good or bad. Mostly bad because it takes away from the aspect of volatility or lack thereof and diversity when it comes to an ETF. So I feel like that's one reason why they're lowing. But the bigger reason, in my personal opinion, is simply affordability. They want to show that this stock is affordable. They want to attract more people to invest into it, which is pretty funny because a lot of platforms, including Robinhood and M1 Finance, have access to what's called fractional sharing. But at the end of the day, if you're able to invest in $100 worth of a stock that you know is going to grow, then you rather do that. And I'm sure it's a lot easier than investing in a $400, almost $500 stock. So I don't blame them. And what I also didn't know is that this isn't the first stock split that Apple has had. This will be their 5th one. Their first one was in 1987, then they had one in 2000, 2005, and then 2014. And it's really good that they've had these stock splits because in hindsight, if they never did a stock split in 1987 or in any of the other years, then one share of Apple stock would run you about $22,000. I'm not doing $22,000 stocks. I don't even know if I'll fractional share in it. Will I see growth? Probably, but. So that's why I really feel like Apple is a stock that you really want to invest in, and come August 24th when the stock split happens, you definitely want to take advantage of the amount of stocks that you can purchase and the potential growth that will happen in the years to come. The third dividend paying stock that I want to talk about is Microsoft. That's more on my end because I'm a Samsung user, Android goes well with my Microsoft Windows computer, whatever. And there's 2 big reasons why I feel like you should invest in Microsoft, and that's Teams and TikTok. Teams is a video app primarily used by jobs and companies and employees when they're not using Skype, because really who uses Skype anymore? And considering the amount of people that are working at home, Teams is being used a lot more than it has been before, and I feel like it will continue to be used a lot more for the years to come. A lot of jobs are changing the way they have meetings, and I feel like because of this pandemic, it's going to change their perspective of how they handle meetings and other situations for the long term. I don't think it's going to end just right as soon as a vaccine is made. Now, TikTok is a little more of a controversial situation. It's a Chinese-owned company where kids go on there and they do something for like 30 seconds, and they're making billions of dollars every single year. I'm pretty sure the company's made over $5 or $6 billion last year or this year so far up to this year. And Microsoft is on the chopping block to potentially purchase TikTok before it's banned in the United States, which is crazy in my opinion, but that's another subject for another day. Now, Microsoft is known for purchasing major companies such as GitHub and LinkedIn, which are two of their largest purchases, LinkedIn being about a $62 billion company that they purchased, which is doing amazing at this point. But TikTok would cost them about $160 billion just based off the amount of money it could potentially make in the future. But if it purchases it, then I think they'll do pretty great. Hopefully, because Microsoft has purchased other companies such as Nokia and Skype. Again, who really uses Nokia or Skype? If you do, I'm sorry. I mean, I use Skype every now and then because I have to for work, but still, that's just that. Now, Microsoft is about a $200 stock, and it does have a low dividend yield that it pays out every single quarter, but I feel like this company will continue to grow. I believe it's grown over 70% in the past 5 years. Hopefully I'm correct about that. So I feel like it does have a positive trajectory within the next 5 to 10 years. The fourth company is a company I've never heard of, and it's a company that I feel like has a high growth potential, even though it has a really high dividend yield, which I've been told that if it has a high dividend yield, you may want to do a lot of research in it or even stay away from it instead of investing into it. And that company is Delek Logistics. Now, Delek Logistics is in the oil and gas industry, and they are responsible for owning and acquiring pipelines and crude oil and storing them in these pipelines. So they're into marketing and logistics. Now, what's interesting about this company out the gate, that even though it has a 12% dividend yield, which is fairly high, it actually has a PE ratio of 10, which is amazing. What's even more amazing is that Delek Logistics just announced a few days ago that they're going to be increasing their dividend payout to 90 cents a share, which is pretty high. And what's even crazier is that that will be their 29th dividend increase. That pretty much makes them a dividend aristocrat if I'm not wrong. So that's already pretty awesome, especially for a company that's only worth about $30 a share. So now I looked into it a bit more, and the reason that they're able to pay out dividends and increase them every single quarter is because of something called assets. Now, this company stores crude oil in pipelines and transports them to other refineries around the United States, including parts of West Texas. And the storage units that they store the crude oil are essentially their assets because other companies are wanting to purchase them, so they're worth something. And there's a metric called the sales to total assets ratio, which measures the amount of assets you get per dollar that you spend on something. And their sales to total assets ratio is 0.74, meaning that for every dollar they have in assets, they get 74 cents in sales. That gives them enough money to put back towards their company, which gives them also enough money to pay back to shareholders like you and me, which then gives them enough money to also increase their dividends if they choose to, which is more appealing for stockholders to continue investing into them and invest more, or invest into them if they haven't already, which I know I definitely will in the near future. And the fifth stock, yes, is a monthly dividend paying stock. I only added it to this list because it's showing a lot of consistent growth, especially with its dividend payouts. And if you haven't guessed it yet, or if you didn't look at the description below, it is Realty Income, aka the monthly dividend paying company. This company is a REIT which acquires tenants that include major stores like Dollar Tree and Walgreens. And I'm pretty sure a lot of people are going to Dollar Tree and Walgreens for their general essentials and medicine and other things like that, despite what's going on in the world. So they're still making money off that. And since they're a REIT, they're required to pay 90% of their income back to the shareholders, which is why they pay you every single month. But this company's been doing that super consistently. I believe they've paid over 300 months consecutively of dividend payments, and they've increased it by at least 30 quarters consecutively. So this is a company that is built to continuously pay you and continuously increase the amount of payments they're giving to you, which is why they're so appealing to shareholders, including myself, to invest in. And plus, they have a pretty appealing dividend yield of about 5, almost 6%. The share price is currently about $60, so that's definitely a company that's pretty affordable, and you know you're gonna get long-term growth and at least consistent and increasing dividend payments. Now definitely drop a comment if you guys have invested into any of these companies or plan on investing in any of these companies. And make sure you check out some of these other videos that will hopefully help you guys in your investing journey as they have in mine. I appreciate you guys watching, and until next week when I'm a little bit older, take care.